Hey, what's up, guys? We are going to review Tesla to see where it's gonna go. This guy keeps going down and making a new lows, and today it hits 52 weeks low, and I'm hoping there is a sign of a little bit of a strength somewhere around here. But in my opinion, Tesla has still room to go down, but nobody knows. But all we can do is create our own strategy and looking for the strong support and resistance. So as you see here, this area that I'm drawing, this is the area of significant support, and as you see the trend line, it's broken a while ago, and Tesla keeps going down, but today it hits the 110.09, actually 110 price, which is the lowest in 52 weeks, and we are heading towards the support. As you can see, the support it's about 100. Sometimes it's a couple dollar up and down, but depending on what risk and rewards you are going for. Just keep in mind, if you're long holder, you want to go as an investor, so you can always hold, but the same thing, you never know when the bottom is going to be. We are just predicting, anticipating those major support holds, so we can at least take a trade out of it and make some potential that probably is going to come in our way. So let's see how you want to trade this. There's a few ways to trade stock like Tesla, especially if you're an investor or long holder or looking for a good move. Because Tesla is being oversold now, it's a potential that it's gonna be moving up or get a squeeze pretty soon. The only problem is now, because it's Christmas holidays and New Year's is coming, it might be not happening at this time until the at least New Year's is past, and it's the market is open regularly. But I would suggest there are a few things to do. If you want to buy it on 100, uh, to me it's a buy at 100, and your support would be basically your $100. If you want to have a tight support, you can always put the stop loss pretty close to 199 or 98, couple dollars, a dollar. The 100 is also natural support that a lot of traders are looking at it, so that's why it's very important to spot at the price. Depending on what kind of uh, you know size you're going to get Tesla, but in my opinion, you could do two things here. You could buy a Tesla and at this area around 100, as I said, and then 1/3 of your position is filled, and keep the other third for the next support, which is going to be another 30%. And of course, that would be your 2/3 of the position, and the last third would be on the third, hopefully the last support. But I kind of doubt it's gonna go that far down, especially we see a lot of good support in the area of 175 and also 63 and 65. So that's my approach. But it's also good to look at the other option. Option would be to buy 100 share and sell cover call against your position. How is that gonna work is you own 100 shares of Tesla, let's say, and you sell 1 contract of your position, which is for each 100 you get to sell 1 contract. Assuming your strike is 115 or 10, depending on what you're looking at, but from these days I see Tesla moves $5 to $10 a day, so your ATR would be $10 or $15. Now you can just sell that strike price on a weekly basis and collect this premium. That would be the nice way of protecting your downside. However, the downside of this approach is if they started going really above your strike price on the expiration date, you have to assign those stock and share to the buyer. So we have other options too that I'm going to explain, hopefully make it easier to understand. So let's assume you want to buy the Tesla stock at $90. Now it's 100, you want to get them really good discount. So what you can do is sell put options at the price that you want to buy, or you love to buy the stock at that price, because why not? $10, $15 off. So you sell a put option at the price you want to buy, and you get to keep that premium. Let's say price of the stock is at $90 or $100, and you say, you know what, I'm gonna wait. What if I just sell a premium of 85 and keep that premium, plus if the stock goes down, then you get to keep the premium, plus the stock at that strike price would be assigned to you, which is $85. That's the best way to purchase the stock that you want to own. So that's why collecting a premium at the price that you are taking a contract, and you getting the premium and then buying a stock at the lower price if it goes down. If it doesn't go down, then you get to keep that premium, which is $10 or whatever amount is, and then you buy the stock at the price that you plan to buy. Either if it's 110, let's say, you still got that $10 premium, which it's gonna reduce you. So this was what I was trying to share with you guys. As I said, let's just recap. Buy the stock at the price that you purchase in at 100. This is what we're thinking. This is the main support. We buy the stock at 100, and then we sell the cover call against it, keeping in mind we want to keep the cover call in a weekly basis, so that way we get to enjoy the time decay and we keep the premium. If the stock goes to the price strike that we sold it at, we assign the call and keep the premium, which is profit. If the stock doesn't go up, we keep the stock, we keep the basically premium. So the other option was, of course, sell put option at the price you would love to own the stock. In our case, let's say 90 or 85. You sell the put option on the stock at 85. If it goes down, you keep the 85 premium option, plus you get to buy the stock at the price of 85, which is already discounted $15 below what you were initially going to buy. I hope you guys enjoyed that video and it was helpful for those who don't know about this strategy. And also, if you have any comment, appreciate if you can leave it below, and a thumbs up would be so appreciated. And if you're interested for a video like this, you can go ahead and subscribe, and I will see you in my next video. Thanks again and enjoy your trading.